All right, everyone, settle in. Let's get started. Today, we're going to dive into a topic that is, and I'm not exaggerating, the absolute bedrock of doing business in Canada. For your future careers, this isn't just important, it's essential.
We're breaking down the GST and HST system. Now, I know tax can seem dry, but listen, for any of you who are going to be accountants, advisors, or maybe even run your own business one day, this isn't just for the exam. This is the real world. Understanding this system is a fundamental skill, and we're going to get it right.
So, here's our game plan for today. Think of it like we're following a brand new business on its tax journey. We'll start with the basics. What even is this tax? Then we'll hit that first big decision. Do you need to register? From there, we'll get into the nitty-gritty of the calculations, talk about getting your money back with credits, and finish up with how to file and the key rules you just can't forget.
Okay, first up, before we even think about punching numbers into a calculator, we have to understand the theory. What is this tax all about? Why does it even exist? Let's get the foundation right. At its heart, GST/HST is a consumption tax. And here is the single most important concept I want you to grasp today. Businesses don't really pay this tax. They act as tax collectors for the government. Think of them as a temporary holding account for the tax money. Now, that H in HST, that just means some provinces, the participating ones, have blended their provincial sales tax with the federal GST to make one single harmonized rate. It just simplifies things. This brings us to the first massive decision every new business faces: to register for GST/HST or not to register. And as we're about to see, it's not always a choice. Getting this wrong can lead to some pretty serious financial penalties down the road. So what's the trigger? What gets this whole ball rolling? It's something the law calls a commercial activity. And I want you to look at how broad that definition is. We're not just talking about a coffee shop. It's any adventure in the nature of trade. It's designed to capture almost everything. Now, there are a few key exceptions, like things you do as a hobby with no real hope of profit, or, and this is a big one we'll come back to, making exempt supplies, like renting out an apartment long-term.
So this is it, the million-dollar question for every new business owner and their accountant. When does this stop being optional and start being mandatory?
And the answer lies in becoming what's known as a small supplier. Here's the magic number: $30,000. If your worldwide sales of taxable goods and services are more than $30,000 over any 4 straight calendar quarters, you're no longer a small supplier, and you must register. The moment you cross that line, it's mandatory. Oh, and a huge exception to write down: this rule does not apply to taxi or ride-sharing services. For them, registration is mandatory from the very first dollar they earn.
Okay, let's move into the mechanics. So a business is registered. Now what? Well, now they are officially in the GST/HST loop. It's this constant cycle of collecting tax when you sell and claiming credits when you buy. This flow is the absolute heart of the whole system. Everyone, I want you to burn this slide into your memory. This 4-step calculation is what you'll do on every single GST/HST return ever. Step 1, add up all the tax you collected from customers. Step 2, add up all the credits you can claim on your business purchases. Step 3, subtract the credits from the tax you collected. That's your net tax. And step 4 is simple. If that number is positive, you send it to the government. If it's negative, they send you a refund. That's it. Let's zoom in on that second step because it's so important. Input tax credits, or ITCs. This is the whole reason we call GST a value-added tax. The idea is to avoid tax on tax on tax as a product moves through the supply chain. You don't want the lumber yard, the furniture maker, and the furniture store all getting taxed on the same value. By letting each business claim back the tax they paid on their inputs, the system makes sure that ultimately only the final customer pays the tax. So an ITC is basically a refund. It's the business getting back the GST or HST it paid on legitimate business expenses. Now, the key phrase here, the one I want you to highlight in your notes, is in the course of their commercial activities. This is your North Star. If you spent money to help you make taxable sales, you can probably claim an ITC. If you spent it for personal reasons or to help you make exempt sales, then you can't.
And the government is very clear about what's off limits. You can't claim ITCs on things you buy for yourself. That golf club membership you use to entertain clients? Sorry, no. And again, this is so important if you buy something to help you make exempt supplies, like, say, new flooring for that residential apartment you rent out. You can't claim an ITC on it.
Okay, let's make this real with a textbook example you'll see all the time. Imagine you own a building. The main floor is your retail store. That's a commercial activity. Upstairs, you have an apartment you rent out to a tenant long-term. That's an exempt supply. You get one utility bill for the whole building, and on it, there's $80 in HST. You can't claim the whole $80, right? So you have to allocate. Let's say, based on square footage, you figure out 70% of the utilities are for the store. That means you can claim 70% of the $80, which is $56. And remember, the burden is on you to prove that your 70% calculation is fair and reasonable.
All right, you've done all the math. Now comes the moment of truth, filing the return and settling up with the government. And in this area, two words are all that matter: accuracy and timeliness. You have to be right, and you have to be on time. I want everybody to stop and read this quote very, very carefully. This is a critical warning from the Canada Revenue Agency. Let me translate it for you. If a customer lies to you and says they're exempt, and you don't charge them the tax, the government doesn't care. They will come to you for that money. The responsibility to collect is always, always on the business.
Now, here's a very important practical update you need to know. As of the beginning of 2024, if a business owes $10,000 or more in GST/HST, they must pay it electronically. The days of mailing in a big check for your tax remittance are over.
And here are a few other essential rules of the road. First, almost all businesses now have to file their returns online. Second, how often you have to file, every month, every quarter, or just once a year, depends on your annual revenue. And third, and please remember this one, you must file a return for every period, even if you had 0 sales. It's called a nil return, and if you don't file it, you will get penalized.
Okay, I know that was a lot of information, so let's take a step back and boil it all down into the core principles you absolutely need to take away from this.
If there is one thing that consistently confuses people, it's this difference between taxable and exempt supplies. So let's make it simple. It's a trade-off. For taxable supplies, you must charge the tax. But the good news is you can claim ITCs on your expenses. For exempt supplies, you don't charge the tax, but the trade-off is you cannot claim ITCs. It's a two-way street. That's why a dentist's office, which provides exempt services, has no reason to register for GST. They can't claim any ITCs anyway.
So this is your final checklist. This is the cycle you'll go through again and again. First, always know if you need to be registered. Keep an eye on that $30,000 threshold. Second, make sure you're charging the right tax. Third, keep meticulous records. My mantra for you is simple: no invoice, no ITC, period. And finally, do the math right, file on time, and pay what you owe.
I'll leave you with a final thought, something to connect these rules to the big economic picture. Think about this. You go and buy a laptop for school, and you pay the full HST. A business buys that exact same laptop for its office, and through the ITC system, it effectively gets a full refund of that HST. What does that do? How does the very structure of our tax system create an incentive, a little nudge for businesses to invest and spend, compared to how it treats personal spending? Think on that, and we'll pick things up right there in our next lecture.